Imagine losing a staggering $200,000 in home value, or seeing 11% of your wealth vanish in just 12 months. This isn't some chilling forecast for the future. It's already happening, right now in 2025. America's once red-hot housing markets are turning ice cold, and the ripple effect is just beginning. Cities like Miami, Phoenix, and Boise are watching home values collapse faster than you can blink. Investor-owned homes, they're flooding the market. Mortgage defaults, ticking up. And in some zip codes, a shocking 1 in 3 listings have already slashed prices. Here's the brutal truth. Incomes aren't rising, but insurance, taxes, and mortgage costs are skyrocketing. The result? Buyers have vanished, sellers are in a full-blown panic, and these housing bubbles are popping one by one. Today, we're taking you to ground zero for America's next housing implosion. These 10 cities are at the epicenter of a market correction that's catching everyone off guard. Number 10, Boise, Idaho. The secret's out, and so is the boom. Our countdown begins at number 10, Boise, Idaho. Once, this gem was America's best-kept secret. Affordable, scenic, and absolutely thriving. But since 2012, that secret got out in a big way. From 2012 to 2022, home prices here skyrocketed over 250%, with median prices hitting a peak of around $515,000 in mid-2022. That's more than double the national average. But here's the catch. Boise's median household income hovers around just $72,000. This created a dangerously high price-to-income ratio of over 7 to 1, well above the historically healthy range of 3 to 1. During the pandemic, remote workers and Californians poured into Boise, sending bidding wars into overdrive. In some neighborhoods, investors were gobbling up over 1/3 of all listings, pushing prices even higher. But as we hit 2024 and roll into 2025, that momentum has completely reversed. The number of homes for sale has jumped nearly 60% year over year, while demand has sharply cooled. Many sellers are now cutting prices or offering big incentives just to get offers. What's worse, Boise's job market hasn't kept pace with its real estate frenzy. High-paying tech jobs are limited, and many remote workers who fueled the boom are now relocating or heading back to major cities. Meanwhile, rising mortgage rates near 7% have completely priced out local buyers. A monthly payment on a median-priced home in Boise now exceeds $3,200, while average rent is around $1,700, making ownership far less attractive. Price corrections have already begun, with values falling 7% since 2023, and more declines are likely as inventory builds and investor activity retreats. The combination of overvaluation, weak income mismatch, rising delinquencies, and a softening job market makes Boise a prime candidate for a serious housing correction. It's a classic bubble setup, skyrocketing prices, weak fundamentals, and now the air is slowly leaking out.
Number 9, Austin, Texas. The tech dream deflates. Next up at number 9, we head to Austin, Texas. This city was once the poster child for pandemic-era migration. Between 2020 and 2022, Austin saw home values jump over 60%, peaking at a whopping $590,000 for the median home. But by mid-2025, the market has done a complete 180. Prices are falling fast, dropping nearly 9% year over year, and inventory has more than doubled since last summer. What was once a red-hot seller's market has now become a slow-moving correction zone. Austin's tech-driven economy fueled that incredible boom, but recent layoffs at giants like Meta, Amazon, and Tesla have severely shaken buyer confidence. Those high-paying jobs that once justified the insane home price inflation are thinning out. At the same time, Austin's cost of living has become unsustainable for many locals. With a median household income around $78,000, affording a $3,400 monthly mortgage on a median-priced home is a massive stretch, even for dual-income families. Investors, who once made up 25 to 30% of buyers in some Austin neighborhoods, are now pulling out. Many short-term rentals are being dumped onto the market as Airbnb profits shrink. Rent growth has stalled, and some landlords are slashing prices just to avoid vacancies. In 2025, Austin's housing correction isn't just about rising interest rates. It's about an overextended market that grew too fast for its own fundamentals. Unsold homes are sitting longer, bidding wars are rare, and price reductions are happening in almost every zip code. The housing bubble in Austin is deflating rapidly. Without a massive resurgence in tech hiring or a sudden drop in rates, the city could see an extended market cooldown. For now, it's a buyer's market, but only if you're willing to wait for prices to bottom out. Number 8. Las Vegas, Nevada. The gamble that didn't pay off. Coming in at number 8, it's Las Vegas, Nevada. Vegas has always been a boom and bust city, and in 2025, the bust is definitely setting in. After hitting peak median prices near $475,000 in mid-2022, Las Vegas home values are now down nearly 11% year over year, one of the fastest drops in the entire country. The desert heat simply can't stop this market from cooling rapidly. Much of Vegas's recent growth came from investors and remote workers flocking in during the pandemic. By 2022, investors made up nearly 30% of all home buyers, and thousands of properties were converted into Airbnbs. But now that tourism patterns are stabilizing and the novelty of short-term rentals is wearing off, many of those same investors are selling, and fast. The result? A flood of new listings and sharp, desperate price cuts. Meanwhile, wages in Las Vegas remain stubbornly low, with a median household income hovering around $64,000. Mortgage payments on a median-priced home still exceed $3,100 at today's interest rates. That glaring mismatch is squeezing local buyers out of the market. Delinquencies are also on the rise, with FHA and VA loan defaults creeping upward, a troubling echo of the 2008 crisis. Another factor? Overbuilding. Home builders rushed to meet pandemic-era demand, but many of those homes are now sitting vacant. New home incentives, price discounts, and even mortgage buy-down offers are common as builders scramble to offload inventory. As of mid-2025, the Las Vegas market is clearly in correction mode. Sellers are slashing prices, days on market is rising significantly, and buyer traffic is slowing significantly. And with more interest rate hikes still possible, the pressure isn't easing anytime soon. Las Vegas gambled on nonstop growth, and now the house may just be collecting. This bubble isn't bursting all at once, but the air is definitely leaking out.
Number 7. Nashville, Tennessee. Dissonant notes in Music City. Our next stop at number 7 is Nashville, Tennessee. Music City's booming popularity turned it into one of the most overvalued markets in the South. From 2015 to 2022, home prices here surged nearly 140%, with the median home hitting $465,000. But by mid-2025, that number has dropped over 8%, and the trend isn't slowing down. Nashville's housing market is rapidly deflating. What drove the boom? A perfect storm of investor demand, out-of-state buyers, and short-term rental speculation. At one point, over 30% of home sales in certain zip codes were investor-driven, effectively pricing many locals out of their own city. But now, Airbnb revenues have declined, tourism has plateaued, and many investors are fleeing the scene. Listings once described as vacation rental gold mines are now sitting idle. The price-to-income ratio in Nashville has grown unsustainably wide. With a median household income around $70,000, most local families are simply priced out of a $3,100 monthly mortgage on a median home. That affordability crisis is pushing more people into renting, which, ironically, isn't much cheaper at around $2,100 a month for average rent, though it's flattening. Inventory in Nashville has increased by over 50% year over year, and builders are slowing construction or even canceling projects altogether. Sellers are offering closing credits, price cuts, and even appliances just to attract offers. Days on market have more than doubled compared to early 2022. Even the city's thriving entertainment and healthcare sectors can't fully insulate it from this housing volatility. As mortgage rates stay elevated and buyers get more cautious, Nashville's housing correction looks like it's just beginning. For a city built on crescendos, this one's now hitting some truly dissonant notes. The Nashville housing bubble is leaking fast, and the chorus of price cuts will only grow louder in 2025. Number 6. Phoenix, Arizona. The Desert Freeze.
Heading to number 6, we find Phoenix, Arizona. This city saw one of the wildest real estate rides in the nation. From 2020 to 2022, median home prices soared over 70%, topping out near $480,000. But by 2025, the tide has turned hard. Prices are now down over 9% year over year, and the cracks are deepening across the entire valley. A flood of pandemic-era buyers and investors, many from California, pushed the market to unsustainable highs. But today, many of those buyers are underwater, quite literally in debt. With mortgage rates hovering around 7%, the monthly cost of owning a typical home now exceeds $3,100, far outpacing Phoenix's median household income of $72,000. Inventory has jumped by more than 55% since last year, and homes are lingering longer on the market. Even newer builds are facing heavy price cuts as overzealous construction in 2021 and 2022 now leaves developers scrambling to unload unsold units. Builders are offering cash incentives, interest rate buydowns, and even full appliance packages just to close deals. The rental market is also softening. Investors who banked on endless rent increases are facing flat demand, and some are selling their properties after months of vacancy. Meanwhile, distressed sales and price reductions are creeping back into the headlines, reminiscent of Phoenix's painful 2008 crisis. Even though the city's strong long-term growth, the current market is correcting fast. Zillow and Redfin both project continued price declines through the rest of 2025, especially in outer suburbs like Buckeye and Queen Creek. The sun may always shine in Phoenix, but the real estate forecast is definitely cloudy. Prices went too high too fast, and now gravity is doing its work.
Number 5. Tampa, Florida. High tides, higher costs. At number 5, we land in Tampa, Florida. Tampa was one of Florida's hottest housing markets until it wasn't. From 2020 to mid-2022, home prices here surged over 65%, with median prices peaking near $420,000. But in 2025, the trend is unmistakably downward. Prices have dropped more than 10% year over year, and inventory is rising fast. The market was fueled by remote workers, retirees, and especially investors. By 2022, Tampa had one of the highest investor-to-home buyer ratios in the nation, with 35% of homes purchased by investors in some areas. But now, many of those investors are bailing, particularly as Florida's sky-high home insurance premiums, now averaging $4,200 per year in Tampa, begin to crush profits. Locals are being priced out. With a median household income around $62,000, affording a mortgage for a $400,000 home at 7% interest means monthly payments over $2,900, and that doesn't even include insurance and taxes. That's nearly 60% of gross monthly income for many families, well above recommended affordability levels. The rental market is also cooling. Rents are leveling off after years of growth, and rental vacancies are increasing, especially in condo-heavy areas like downtown and the Channel District. Meanwhile, builders are offloading inventory with aggressive discounts, contributing to the price slide. High interest rates, soaring insurance costs, and an affordability crunch are all weighing down Tampa's housing market. More than 20% of active listings in 2025 have had price cuts, and buyer traffic has dropped substantially. Tampa's sun-drenched appeal just can't mask the numbers anymore. The correction is on, and those who bought at the top are starting to feel the heat. This once booming market may be in for a long, slow cool down. Number 4. Denver, Colorado. The mile-high market comes down to earth. Our journey takes us to number 4, Denver, Colorado. This vibrant city, a beacon for tech and outdoor enthusiasts, became an undeniable magnet during the pandemic. Homebuyers seeking sunshine, mountains, and a thriving economy poured into the mile-high city, pushing median prices in Denver above $630,000 by 2022, an astounding 65% increase from just a few years earlier.
But in 2025, those gains are reversing fast. Home values are down over 9% year over year, and the decline appears far from over. Why the sudden reversal? Because affordability has completely collapsed. Denver's median household income is only around $87,000, yet monthly mortgage payments on a median home now top $4,800 with a 7% interest rate, representing more than 65% of income for many buyers once taxes and insurance are factored in. That's making home ownership a pipe dream for most locals. Inventory is ballooning. Listings are up almost 55% compared to last year, and builders are slashing prices or pausing construction altogether. Some planned communities have even been delayed or canceled due to rapidly lagging demand. Denver was also hit hard by speculative buying. Investors and flippers snatched up properties expecting endless appreciation, but rising rates and a softening tech sector have crushed those expectations. The shift away from full-time remote work is also making Denver less appealing to out-of-state migrants who once flocked here. Buyers are hesitant, sellers are desperate, and the median price has fallen more than $60,000 in the past year alone. The Rocky Mountain high that fueled Denver's market is giving way to a significant correction. In 2025, Denver is proving that even picturesque mountain markets can become seriously overpriced and overcooked. The correction here is very real, and it's happening fast.
Number 3. Salt Lake City, Utah, sliding down the other side. At number 3, we head to Salt Lake City, Utah. Salt Lake City's housing market was on fire throughout the 2010s and early 2020s, but 2025 is painting a much colder picture. After home prices soared over 100% between 2015 and 2022, the median home value peaked at around $575,000. Today, those prices are in full retreat, down more than 9% year over year, and the momentum is still heading south. A major issue is, again, affordability. With a median household income around $83,000, buyers now face monthly mortgage payments topping $3,900 at current interest rates, well beyond what most locals can sustain. This has pushed many first-time buyers out of the market, while others have paused purchases entirely, waiting for prices to fall further. Salt Lake's popularity with out-of-state buyers and remote workers helped inflate this bubble. But now that remote work is shrinking and big tech companies have scaled back hiring, the flood of new demand has dried up. Builders who were rapidly expanding during the boom are now left with excess inventory and are slashing prices on new homes. Investor activity is also falling off a cliff. Properties once purchased for Airbnb or long-term rentals are being sold at losses, especially as rents flatten and vacation travel patterns shift. The city's price-to-rent ratio is now among the highest in the region, a clear indicator that home prices are wildly out of sync with fundamentals. Active listings are up nearly 60% year over year, and homes are sitting longer, with more than 30% of listings undergoing price cuts. Despite the area's strong long-term potential, the short-term correction is hard to ignore. Salt Lake City's housing market climbed too high too quickly, and now it's sliding down the other side. 2025 is proving that even mountain markets aren't immune to gravity. Number 2. Atlanta, Georgia. The southern metropolis slows its roll. Our second-to-last city, at number 2, is Atlanta, Georgia. This sprawling southern metropolis, a magnet for corporate relocations and new residents, saw its housing market boom to dizzying heights. Between 2019 and 2022, home prices here surged by nearly 60%, pushing the median home price above $425,000. But in 2025, that rapid ascent is definitely losing altitude. Home values are down over 8% year over year, and inventory is swelling across the metro area. Atlanta's once celebrated affordability advantage has evaporated for many. With a median household income hovering around $75,000, today's mortgage payments often exceed $3,500 for an average home. That's pushed the price-to-income ratio well into unsustainable territory. Combine that with stubbornly high interest rates, and local buyers are simply stepping away in droves. Another major red flag here, investor saturation. By 2022, a significant portion of all homes sold in Atlanta were to investors, particularly in fast-growing suburbs. Now many of those properties are being dumped back on the market, especially as rent growth has completely stalled and the flood of new renters has slowed. The result?
More supply, significantly fewer buyers, and falling prices. Homes are sitting longer, seller incentives are increasing, and price cuts are widespread across the city. Builders are also under pressure, offering steep discounts to clear out new construction before values fall further. Atlanta's rapid population growth helped fuel the demand, but that growth is now easing. While the job market remains diverse, the frenetic pace of hiring that characterized the boom years has cooled, especially in certain corporate sectors. In 2025, Atlanta is experiencing the undeniable hangover of its own extraordinary success. The housing bubble, inflated by investor frenzy and relentless in-migration, is now unwinding. While the city still boasts strong fundamentals long-term, this year is unequivocally about correction. The bubble isn't bursting in one dramatic pop, it's leaking steadily, and the air is escaping fast. Before we reveal our number one city, make sure you're subscribed to Discover the Nation for more eye-opening insights into the American economy. Just click that subscribe button below.
Number 1. Miami, Florida. The tropical cautionary tale. And finally, our number one city for America's next housing implosion, Miami, Florida. Miami's housing market in 2025 is looking more like a cautionary tale than a tropical paradise. After peaking in early 2022 with a median home price nearing $600,000, Miami's market has reversed sharply. Prices are down over 11% year over year, and the decline is accelerating in areas like Brickell, Wynwood, and even parts of Coral Gables. What caused this massive bubble? Investor fever. Foreign buyers, crypto millionaires, and Airbnb hopefuls flooded the city during the pandemic, often buying multiple properties with cash. At one point, over 40% of all home purchases here were cash deals. But today, even those investors are selling as the numbers no longer make sense. Insurance premiums have become unbearable, averaging over $5,000 per year, while climate risks, including sea level rise and hurricane damage, have driven up costs even further. On top of that, property taxes are high, and many condos are facing massive special assessments due to new safety regulations after the tragic Surfside collapse. Meanwhile, the local economy is struggling to support these inflated home prices. Median household income is just $57,000, yet buyers face monthly mortgage payments north of $4,200. That drastic mismatch is causing sales volume to plunge, while inventory has jumped by more than 60% compared to 2024. Airbnb saturation is another huge issue. Thousands of short-term rentals are now vacant or underbooked, leading to fire sales and rising foreclosures. Even luxury markets are being hit, with multi-million-dollar condos lingering unsold for months. Miami's real estate party went on too long, and now the hangover is brutal. This is no longer just a cooling market, it's a rapid correction in progress. In 2025, Miami tops the list of America's next housing bubbles, not just because of falling prices, but because the fundamentals never made sense to begin with. And now the reckoning is here.